we turn to, of course, our in-house market master, Udayan Mukherjee joins us. Good morning, Udayan. Good to have you with us. It's a crucial day of trade for the markets. A blank check question. What have you made of the budget from a market's point of view?
Well, it's more good than bad, Lata. I did not have my expectations raised very high. Budgets tend to be more or less non-events for the market. I think this one, too, is more or less a non-event. We'll speak less and less of this in the days to come. Maybe a couple of days later, we'll not be speaking so much about the union budget. But I don't think it was earth-shattering. But as I said, it's more good than bad. And it sort of reassures people in the business community that this is a government which will generally keep the framework for business and for the market supportive in the months to come. It will not radically change anything, but it will keep the framework supportive. And from an investor's point of view, I think this was a big event which was in front of the market, and now it's out of the way without having provided any great negative triggers. You will recall that a lot of people were talking about the prospect of a correction if the budget turned out to be disappointing. And I think a lot of firepower might have been kept at bay because of this event. And now that it's out of the way, I think one can safely say that this event, even if it does not turn out to be a massive positive trigger for the market over the medium term, it is certainly not a negative trigger which will lead to a massive correction in itself or by itself for the market. So I think that's one way of looking at it, that this is not the event or trigger which, because of the weight of valuations right now, triggers off or sets off an overdue process of correction in the market. And generally, it has more good things for the market than bad.
Udayan, hi, good morning. What the government has also tried to do through this budget is improve the ease of doing business, especially for some of the foreign investors, like the deferral of GAR, the removal of MAT, etc. How are you gauging the foreign money entering into India? Do you see more amounts of it come into our country now?
Well, in some specific stocks, Sonia, it will happen because of the weightages going up in the MSCI. Part of that has already got factored in on Saturday in specific stocks like Axis Bank. So at a micro level, there would be triggers to get into certain stocks because of the changes which have come into the budget. Otherwise, for the next couple of days or beyond the next couple of days, I don't think the budget in itself will lead to a lot of additional flows in the market. I think India has generally been overweight in the emerging market basket for most FIIs. Is the budget an event which will keep the market or keep investors overweight on India as a destination? I think the answer to that would be yes. But I think right now, because of so much emotion which is invested around this event, you will hear people talk about more money, less money. But I think after this week passes, you will hear less and less people talk about this budget as a transformational event for the market or for the economy. As I said, it has probably more good things than bad. But in the longer term, I don't think it changes the roadmap for the market very significantly. In the near term, because of the sigh of relief that it's not a terrible budget, you will probably see the Nifty hitting 9,000 this morning, which was expected in any case, and may go on to stretch maybe a couple of 100 points on the way up, maybe to something like 9,200. Beyond that, I think the tailwinds and the headwinds remain the same. The tailwinds remain very positive sentiment and very positive technicals, which is the kind of flows that we are getting. And the headwind remains the weight of valuations in the absence of earnings. And I think these tailwinds and headwinds will sort of balance each other out and keep the market floating in this 8,500, 9,200 range for the time being.
Okay. Then, as you mentioned, valuations is a headwind for this market. Is there anything in the budget at all which might actually, push back the hope that earnings growth is going to come sooner? There is already a higher corporate tax. I mean, it's gone up to 34.6 because of the surcharge. As well, if you are told that from FY16 you're going to get a lower tax, it might even tempt people to push their earnings, tempt corporates to push their earnings to FY17 rather than FY16 because you're going to be taxed less. And I don't know, is there any immediate trigger for growth itself, for growth in earnings and profit for FY16?
You're right, Lata, but I think the way the market or investors are approaching this market is less with an eye on immediate earnings, but with an eye on sentiment and hope, and that things eventually will turn, and whether this budget gave that hope a little bit of a prod. So I think the regime is very different right now for the market, and people want to be more hopeful and more optimistic than pessimistic. So if this was a question or a budget which happened 3 years back, maybe the reaction would be quite different. But right now, people look at the market with very different shades. And therefore, I think they're prone to accepting this budget as something which just gave the hope a little bit more of a prod. Some more infrastructure spending, the promise of GST coming next year for sure. And I think those will be harped on far more than the small markdown in earnings which might happen because of the budget. So this rally in a large part is to do with the hope that a cyclical upturn is coming. It's not here yet. And I don't think the budget will do anything to dent the hope that a couple of quarters out, this cyclical upturn will happen. So I think it's important to understand where the investor is coming from, what his psychological framework is at this point in time. And I think it's a very optimistic psychological framework that we are analyzing every bit of data today. And in that context, I think the budget will be received as one more positive cog in the wheel rather than something which dents prospects 2 quarters out.
By the way, the pre-opening level has settled about 0.5% higher, and on expected lines, names like Axis Bank are the big movers in pre-opening, up about 3% odd. How do you approach this sector-wise now, Udayan? Because the government has decided to prioritize growth over fiscal consolidation. So a lot of capex into infrastructure, etc. Has the time come to raise your allocation to cyclicals?
Well, people have done that already, Sonia. But if you're willing to just look the other way with earnings for the next 1 year, and maybe not even 2 quarters, but 1 year, because serially you will keep seeing the quarterly earnings, and they'll probably keep disappointing you like L&T did in the current quarter, and maybe some of the other infrastructure providers will do the same. But if you're willing to look the other way and say, I don't trust these earnings because everything will change 1 year out, then I think the time to look at some of what they call in investor jargon, some of the late cycle plays. I think you may start upping the weightage in some of those late cycle plays, which include some of these infrastructure providers that you're talking about. So slowly the window will open. They will start booking more orders. Maybe 2 quarters out, you will not see it in the revenues, but you will see it in the order bookings, which are generally or gradually starting to climb up. And maybe 1 year down the line, you will see it translating into some kind of revenues. So for people who have a slightly greater appetite for risk, I would imagine that they start getting into some of these or upping the weightage to some of these infrastructure and capital asset-linked plays like the ports, roads, these highway kind of plays that we spoke about last time. But also keep an eye on tertiary plays like cement, because I think they will also start benefiting from the kind of boost that we are talking about. Don't abandon autos and auto ancillaries yet. So I think, and banks, of course, you saw the kind of reaction we had on banks. So I think the sector choices remain pretty much the same. But what the budget has done is probably let you go underweight on some of these clusters like maybe tobacco, maybe public sector banks. I think those are the ones, even telecom, those are the ones which will probably come under a little bit of underperformance pressure.
All right. Yeah, we had a CLSA note saying smoking is injurious to wealth. Then how does one look at what to expect from the Reserve Bank and generally the rate cycle, and what is the message for the markets there?
I don't think there is room for any major disappointment. I think the Reserve Bank will understand where the government comes in from. Sure, you could see the bond yields harden, maybe even close to 780 in the near term, but I don't think it's earth-shattering. You may have to wait a little longer for the rate cuts to kick in, but eventually I think the bond yield is headed to 750 and lower. Rate cuts will probably materialize, and you will still get 2 or 3 more over the course of the next 6-9 months. So I don't think the picture has changed dramatically on that side, but I think more than that tailwind, the market will probably have to feed on the hope that growth is going to be restoked because of the kind of capex cycle unlocking that the government is trying to do. So I don't think the Reserve Bank rate cut is the top of the tailwind list for this year. Maybe later, maybe next year, we see more acceleration in the pace of rate cuts. But this year, if you're asking what is the single most important thing which drives stock markets from here, I don't think it's Reserve Bank rate cuts. They will probably play a supportive role. I think the biggest growth driver for the stock market is the hope and evidence towards the end of the year that the capex cycle is slowly unlocking, which will pave the way for a very big 2016 and even bigger 2017 going forward. So this year is probably range-bound to middling, but 2016 and 2017 could be the bigger years from a stock market performance point of view.
Wow, that's a photo finish. Thanks a lot, Udayan.